Hope everybody is doing well. And as always, if there's any audio issues, just feel free to make a comment in the chat. Really interesting day. And first, let's talk about the daily chart. So on the daily chart, you can see that we have had a lot of trading range price action. Whenever you have a lot of trading range price action on the daily chart, in other words, to keep it very simple, whenever the market is in a tight trading range on the daily chart, there's every time you get a strong trend from the open or trend on the 5-minute chart, it's likely to fail. And we've had that over the past few days. We had a strong trend yesterday. I say strong. We had a bear trend yesterday, tight trading range. You can call it a bear channel. We broke below the bottom of the channel and we started trending. But from the beginning, there were issues on the 5-minute chart with yesterday. Big bear bars, climactic bars, lots of buying pressure, and other reasons. But mainly the daily chart. When the bars get too big and too close to the bottom to support, the odds are you're going to get a pullback. In other words, when it gets too close to this bar, the August 22nd low, what ends up happening is traders start buying due to higher time frames, and that's what leads to this, a sudden rally and then a channel. And obviously we had a channel for several bars. And then the same issue here. So the high of yesterday is 44.5. And that is right here. So every day I always draw the prior day's high and the prior day's low. And here is the prior day's high. Today we gapped up and we started to rally with we started to go sideways with bar 1. And the market started to go sideways. And then you can see the market rallied above the high of the day. But this is what I'm talking about. This rally, even though you look at it and you think, yeah, it's a trend from the open, the problem is that these, due to higher time frame context, they're deceiving. I'm going to turn the screen off and pull up a PowerPoint that I want to show with some examples. Okay, so here, this is what I'm talking about. I've not finished this slide, so ignore all the text. The text is really a place marker, but you can see this is a 5-minute chart on the left, and we had a very strong bull trend day that lasted for a lot of bars. And look at the 60-minute chart. This is the 60-minute chart on the left. And what do you notice? The context of the small pullback trend was actually really, really good for the bulls. We had a trading range, we had a bull flag, we gapped up on the 60-minute chart, went sideways to the moving average, and we're getting a rally. That's a sign of strong buying. Let me see if I had a chance to make any others. Here, not so good context. This is a bear trend, and this day was December 22nd, 2022. We had a very strong bear trend, but the issue with the bear trend was the market opened in the middle. I believe this is a 60-minute chart. I'll double check. I believe it's got to be a 60-minute chart. And actually, I know it is. This is a 60-minute chart, and we have a tight trading range here. And you can see the moving average. We're in a clear bear trend. We had gapped up, or we broke above the moving average, and then we sold off with this day. But this sell-off was a lower low major trend reversal. And this right here, this bottom, that was a strong bull reversal bar in what was likely to be a trading range. You can call it an expanding triangle here and here, but this is more of a buy zone than a sell zone. And because of that, down here, there's actually increased risk that you get a strong reversal. So whenever you look at a small pullback trend, always think about the higher time frames. That'll help you determine whether the day is going to remain a small pullback trend or not. That's why Al says that 60% of the time when you get a trend from the open or small pullback trend, they transition into, that's actually supposed to say a trading range, TR, and that's due to higher time frame context supporting the trading range. And I thought that was a just great example. Here, this day, it's not, I tried to find the day, but I couldn't find it. It was not June 24th, of this year. Let me just actually check. So let's see. So you can see that was actually, I mislabeled that day. It actually might be this day. It's actually this day right here. So it's actually June the 5th of 2024. I'm going to make that correction. So that is June. That is June the 5th of 2024. I always try to add the day or the date so I can refer back to it. I make notes as I build the slides just so I don't forget what I'm thinking through. But here's what I wanted to show. So we had a very strong small pullback trend lasting the entire day. And the reason why I'm showing this is you have to learn to understand what trends are going to last the whole day and what trends are likely to fail. And higher time frame context can help you give you that answer. So if we go to June 5th of 24, what do we think the higher time frame is going to look like? If I go to a 60-minute chart, look at this. We have a triangle. You can call it a triangle, doesn't really matter. It's a pullback following a very strong rally here. This rally was strong enough to get a second leg. And look up here. We're testing the high of the past several days. So the context here was actually really good for a tight channel. However, if we let's say go to the 15th or the 10th of 2024, look what happened. Started to go sideways. So all that to say, going back to today's chart, there's a lot of issues with this from the get-go. Part of the issue was just the overall selling pressure. I thought the rally had too much selling pressure on the way up to really make it likely to be a strong small pullback trend. And the other reason is higher time frame context. So first bar of the day, we had a bull bar closing on its high. It's an okay buy for the bulls, taking a chance that we're going to get a rally and a bull trend from the open. However, as you know, most of the time the market goes sideways on the open. So is it really a great buy above one? It's a low probability buy. If I was going to buy above bar one, hoping for a bull trend day, I would trade really, really small, maybe 20% or 10% of a normal position size. And then I would build the position as the market went my way. So you sell, like yesterday, bar one, you sell a very small position below one, and then maybe you add on with bar six. Then you get a big bear bar, you either sell below 15 or sell the pullback 18. Another big bar 21, you sell below it, or you wait for the pullback wedge and you add on there. Lower low major trend reversal, maybe you get out all of your position there. That's basically what the bulls want. The bulls want the opposite of that. We had an example of that a couple of days ago. Is this day right here. Some bulls will buy above 3. They can buy above 5. They can buy above 10. They'll add to their position on 12, and they'll build on the way up because it's higher probability. Bar 2, we have a bear bar. So we have a swing buy for the bulls, swing sell for the bears. I'm always thinking about always in. We have a gap up. Because bar 1 is follow through with the gap, that makes me think that the odds are we're always in long, and bar 2 is probably a pullback from the gap up. Bar 3, bear bar, consecutive bear bars closing on its low. You can take the sell for a swing, but you're selling right at the bottom of bar 1. And the odds are there's probably more buyers down here than sellers. We have a tail on 3, so the market sold off on 1 or bar 2, pulled back on 3, sold off on 3. So in a smaller time frame, it's a two-legged pullback and a possible double bottom with 1. And that's why 4 reversed up. What about buying above 4? Well, there's two issues with buying above 4. One, it's forcing you to buy in the middle of a 4-bar tight trading range. The other issue is buy bulls who bought above 1 and bought more below 1 are probably going to use 4 to exit longs. You also have bears who sold the close of 3, and it wasn't a terrible sell on 3, and therefore bears sell the close of 3. They sell more above the bear bar, and they get out on this bar right here, bar 5. Bulls, it's probably gonna go back to 1. So the bulls buy up here, they buy more on the pullback, or they wait for the second leg down. They buy down here, and the market reverses up. Bar 6, we have a breakout above the tight trading range. We're always in long, so it's okay to be long, but the risk for the bulls is an expanding triangle. Down and up, and then down and up, where you can just say down on 1, up on 2, down on 5, up on 6, 2 pushes down, 1 and 5, 2 pushes up, 2 and 6. If 7's a bear bar closing on its low, that could increase the risk of a reversal. I forgot to mention, but coming into today, there was a risk that this was going to be a trading range day because of the 60-minute chart. So the open of the day is basically right here. And that is a lot of buying pressure from down here. And so that increases the risk that whatever rally we get is going to lead to a trading range. 7, a bull bar, breakout, 6 and 7, but not, we have a weak breakout. Bar 6 actually barely closed above, it didn't even close above bar 2. That's a sign of a weak breakout. And then we have 7, a bull bar with a pretty big tail. That increases the risk that whatever rally we get is probably going to be minor and lead to a pullback. And then we got a bear bar on 8. Good for the bears, but decent bull bars increases the chances that we go more sideways. We're probably going to get back down to the 2 low. It wasn't crazy to sell below 2. Therefore, traders sell below 2. They sell more above. They sell more higher. Chances are they're probably going to be able to avoid a loss. Bull bar 9, breakout pullback 5, but probably sellers above 9. And you can see what happened on 10. 9 is a bad high 1. It's a bull leg in what's likely to be a trading range. And traders sold above it. You had buy the close bulls on 7, disappointed with 8 and 9. They used the rally on 9, or when 10 went above 9 to sell out of their longs, and that's why 10 reversed down. 10 is a second leg down from the sell-off from the 7 high. And you can see what happened. You had a lot of bears buying back shorts down here. What about selling the close of 10? Well, it's probably more bullish than bearish, not by much. And this is not ideal. And then we got a bull bar on bar 11. For the bears, I think a lot of bulls, I think always in bears exit above 11. Bulls can buy, but you're buying in the middle of a tight trading range, and that increases the chances that there might be sellers above. But a decent bull bar closing on its high, second entry after the breakout, 6 and 7, with targets above the high of yesterday, it's an okay swing buy. And then we got follow through on 12, more follow through 13. Looks like a wedge, bar 2, 7, and 13. However, we have a bad sell signal bar for the bears. Bar 13 is a bull bar, and that increases the risk that there's more buyers below it. Wedges, even though this is a wedge, the channel is pretty tight, and that increases the risk that this might lead to an endless rally. In other words, it might lead to a small pullback trend, a bull leg in a trading range that starts to form gaps, and then we end up forming a bull trend. The issue, for the most part, is what I talked about on the higher time frames. We've had a lot of buying pressure, and this is a lot of bull bars in a row, and that increases the chances that we're probably going to go sideways at some point soon, even if we rally a little bit higher. So I'm not convinced we're going to have a strong bull trend day, but the risk for the bulls is we could easily get a measured move of this opening range. And then 14, we broke below 13, reversed up, breakout pullback buy. We have 4 consecutive bear bars with only one closing below its midpoint. So more buying pressure than selling pressure for the bulls. You can be long, stop below 10, taking a chance that we're forming a bull trend. 15, doji, sign of weakness, sellers above 14, but buyers below 14. And why is 15 not a bear bar? That's a reminder that this rally is deceiving, and deceiving increases the chances that it goes higher. Bull bar 16, good for the bulls. Bull bar closing on its high. What about selling it? If you're selling, the targets are very small. Bottom third of the bar, bar 16. And that increases the chances that even if we sell off here, there's buyers down here. So the issue for the bears is the lack of selling pressure. For the bears, if you're looking to sell, taking a chance, we get down to the red line, the 2 low, or the open of the day, or even the low of the day, bar 5. Realistically, the bears are going to need to do more than what they've done right here. And then we got a doji on 17. That is a sign that the bulls are not as strong as they could be. But this is a breakout on a higher time on a higher time frame. If we go to a 15-minute chart, I'm just going to go to the es.d to remove some of the bars to save a little bit of time. But this is, so here is 945, this doji. And here is 945 right here. And it's a decent amount of bull bars. And that increases the chances that we're going to continue to go sideways to up. Let me remove. I just noticed this icon is on. So you can see that is this is decent buying pressure, and that increases the chances of higher prices. What are the chances we've seen the low of the day at this point? We probably have seen the low of the day, at least for a couple of hours. However, if we start getting more bear bars, especially bear bars closing below the moving average, the probability will quickly evaporate that the low of the day is in. Bear bar 18, good for the bears. It's a sign that the bulls are becoming weaker, but that is the first time that's the first opportunity the bulls have gotten to buy a bear bar closing near its low. So bulls are going to buy, and a lot of bears I suspect are scalping. 17, 8, and 19, bull bar, but a bad high 1, probably sellers above it and sideways. But as far as selling 19, you're selling in a tight bull channel, really not ideal. 20, we triggered the buy above 19 and we formed a bull bar. And then 21 broke out to the upside. For the bulls, is this a possible measuring gap? Well, it's a possible, we have a negative gap potentially here and here, but a lot of overlap in here. And the bulls, they have a breakout above 19 with bar 21. That increases the chances that we get a possible measuring gap. But we have one bull bar closing on its high, overlapping of the past 4 bars, and it barely closed above the bars to the left. So while this bar, if you take 21 by itself, it's easy to look at 21 and say, yeah, what a strong looking bar. But if you think about it, 21 broke above the high of 17, barely closed above it. So it's really not as strong as it could be. And that means that traders will want to see the follow through and look at the follow through. 22 rallied and reversed down. Now, one of the things to remember about bars is this is a 5-minute chart. And realistically, bar 22, the current bar, the bear bar, realistically, and I know this because I remember seeing this bar, 22 did not immediately go above 21 and then immediately reverse down and go outside down. So what am I saying? What I'm saying is the open of 22 started to go up, pulled back a little bit, started to go a little higher, and then it started to stall. And a lot of those bulls who were long on 21, they sensed the rally losing momentum. And what are those bulls going to do when they're buying at what could be the start of a trading range or the high at what could be the top of the channel? Well, you know, a lot of those bulls are going to be very quick to sell out of longs. They understand that we have a spike to the high of 7, pull back to the bottom of 10, and we're channeling and we're testing the trend line on 22. So if this starts to rally and hesitate, a lot of bulls will begin to sell. And bears, they know that. They're not dumb. So what are the bears going to do? The bears are going to start selling, and that's what caused this bar. Now, what about selling the close of 22? Is 22 a big bear bar, meaning that everybody is really bearish and that it's time to sell closes? Not at all. In fact, 22 is probably more due to bulls selling out of longs and bears selling for a brief scalp and then traders looking to buy lower. So, as far as selling below 22, it's really not all that great of a trade. Now, why is it not a great trade? Because the risk reward's bad. If you're a bull and you're selling down here, one times your risk is all the way around the 12 low, and that's too much risk relative to the probability. So it's a bad risk reward trade with low probability. Bad entry bar 23, bull bar 24. So some of the bears who sold below 22 will be disappointed and they'll look to exit. 25, we broke out above the 24 high and pulled back. I suspect we're going to try and get a second leg down, but you're right at the moving average, and it's really not ideal. 25, breakout, pullback, sell, bad low one at the moving average, a little bit of a bottom of a trading range in here, so probably buyers below. What about buying above the 26 high? Well, buying above 26 is 2 legs up on a smaller time frame, and there might be more sellers above 26 than buyers. 27, bear bar, second entry sell, but forcing traders to sell in the middle of a 4 or 5 bar tight trading range, right at support the moving average, and that is not a good area for the bears to be selling. The bears, they really need a major trend reversal, and they do not have a credible major trend reversal yet. And that makes me think we're probably going to go more sideways than straight down. 38, a bull bar closing on its high. I suspect more sideways trading here than straight up. What about buying above 38? You can take the buy for a swing, but it's a bull bar closing on its high. But think about the context for a second. It's a bull bar forcing you to buy right at the top of a tight trading range, just above the moving average. That is not an ideal thing for traders to do. And that increases the risk that there might be more traders selling above the bar rather than buying it. And you can see what happened. 39, we have a doji. Traders were disappointed. Traders were disappointed by traders were disappointed by the bull bar 28. So some bears sold, they scaled in higher, and they bought back their shorts on the pullback. Bulls, they did the opposite. They knew it was a bad buy. They knew there were sellers up here, so they bought a pullback as well. Tight trading range, breakout mode, probably closer to 50-50. And then 30, 31, we broke out to the upside. But what happened up here? There were sellers up here last time. And chances are, if we break above 22, there's probably sellers again. Break out of a tight trading range, strong enough bar, we may get a small second leg up. But tail 31, tail 32 increase the risk that we're probably going to go sideways fairly soon. 33, a bull bar. Always in long. Can you buy up here? Well, every time we bought at a new high, such as buying above 17 or buying above 7, the market started to go sideways fairly soon. So buying 33, the challenge with buying 33 and the issue with buying 33 is stop placement. If you're a bull, where are you realistically going to put a stop? Yeah, I have to say it's really annoying. It's really annoying when people. I try and keep up with the comments just so I can make sure that there's not an audio issue. It's really annoying when spammers just put 14 of the same messages. Anyways, the issue with 33 is putting a stop below bar 30. If you put a stop down here, whenever you're in a trade, you always have to gauge the risk reward of every trade. So buying below 30, and buying the close of 33 or being long on 33, stop below 30, the odds are we're not going up here before we pull back. And because of that, a lot of traders are going to be quick to exit the trade. 34, outside down. This is the reason why. This is the reason why traders This is what I'm talking about. Traders are taking profits. The risk reward is bad. Now, what happened when the market pulled back? You had traders buying. Bull bar, 35, good for the bulls, but I suspect more traders selling up here than buying up here. 36, we have another outside bar. So we're starting to go sideways just above the highs, and that increases the chances that we'll probably test down here at some point in the day. 37, bull bar, 38, doji, and then a bull bar 39. Does this look like the start of a very strong breakout, or does this look more like a bull leg and what's going to become a trading range? It looks to me like more of a bull leg and what's going to become a trading range. And then we got a bear bar on 40. For the bears, it's a higher high major trend reversal. We had a decent bear bar 22, and now we have another decent bear bar on 40. 40, you always have to think about the possibility of a midday reversal. So what do you think is going to happen with 40? The risk with 40 is that we test down to the 22 low. Bears sell below 22, they sell more below bear bar. 80% chance they can avoid a loss, 60% chance that we'll get down to the 22 low. However, if you sell below 40 and you put a stop above, it may take several legs before it actually you get the downside breakout. It's basically a higher high major trend reversal. And whenever you're selling, whenever you're taking a major trend reversal trade, you have to be prepared to sit in the trade for a while. So it's a Walmart trade. You sell below 40, you put a stop above 40, and you go for a walk. Follow through on 41, good for the bears, consecutive bear bars, probably going a little bit lower, but bottom of a trading range, bottom of the 34 low, possible double bottom. What do you do if you get a bull bar closing on its high on the following bar 42? Well, I don't think it's really a great buy. It's forcing traders to buy at the midpoint of the trading range, and chances are there's probably sellers above the 42 high because the odds are 40 and 41 are strong enough for a second leg. The stop is above for the bears selling 40. Always in bears, they sell below 40, stop above 40. Always in bulls, exit below 40. And then 43, we have a doji. Some bears that were short, disappointed with 42, scaled in higher, getting out break even 43. And then we got a bear bar 44. And what do you notice? We're touching the moving average, and we've only touched the moving average once today, bar 23. But 41 and 42 and 43 touch the moving average, and we're not racing to the upside. That's a reminder and a warning that this day is not as bearish as it could be. 45, a bear bar, but a doji, not a strong bear bar, so not really sell the close, but not a great bull bar to buy above either. So increases the risk. It's also a micro channel from 40. 5-bar bear micro channel increases the risk of sellers above. And then a bear bar 46, but you can see the sell-off, the momentum is waning or weakening, and that increases the chances we start to go sideways. But every bar that gets added and is below the moving average increases the risk we get the downside breakout. Here, I think the risk is actually real that we do get a sell vacuum test down here. And that's because of what I mentioned on the higher time frames. So for example, 45-minute chart, it's pretty easy to see it. We've had consecutive buy climaxes all the way up. And look right here. We had these really big bars. This was the start. This was the 9:30 close. And this was the next bar. It's probably exhaustion. And whenever you get exhaustion, there's a 50%, you can call it a 50% or 60% chance you get a small second leg, which was this bar right here. Consecutive bull bars, exhaustion. We had a pause on the doji, small second leg up, bull bar. 60% chance you get a small second leg, and then you test the bottom. So I thought the risk was real that if the bears do start getting control, you'll have a lot of traders selling, and we could get a sell vacuum test of the low of 930, which is basically the low of the day. So even though it looks really far away, if we start to continue to go sideways to down, the bulls may give up, and the bears start selling aggressively, and that could take us all the way down to the low of the day. Weak bull bar, breakout, pullback, sell. But why aren't the bulls triggering stop entries? They did here, but it didn't go anywhere. And then we got a doji 48, bull bar 49, bear bar 50. It looks like a bear leg in a trading range. And why not buy below bars and scale in lower betting on a trading range? Well, what do you notice about the past 5 bars, or really 6 bars? All 6 bars are in a tight trading range below the moving average. And that means the bears are strong enough to keep the market below the moving average for 6 bars, really 7 bars if you include 44. And that's a subtle sign of increasing selling pressure. Bull bar 51, but why couldn't it close above the moving average? Range is expanding, but forcing bulls to buy high in a tight trading range not ideal. Bear bar 52, trapping bulls buying the close of 51, and then a bull bar 53. For the bulls, it's an okay. I think for the bears, it's okay to exit above 53, but a very tight channel increases the risk that this rally is a trap, trapping bears out of their shorts and bulls into longs. So buying 53 is really buying in a tight trading range, and that increases the risk that traders get trapped. And that's what happened with bar 55. You can see the market immediately sold off. What about buying the close of 55, betting that it's a failed breakout below 52? I think that is a bad mistake. 55 is a relatively strong breakout below the moving average, trapping bulls who bought above 53. And if 56 gets follow through, we could easily get a sell off. Then we got follow through 56, more follow through 57, more follow through 58. And you can see a lot of the bulls who bought below 54 or more lower, they tried to use the 55, bar 55 to exit their longs. They tried to sell up here, and they were not alone. The bears started establishing shorts as well up here, and that's what led to the second leg. But the issue with the second leg is it's getting a series of bear bars, and that creates a big bear bar on a higher time frame. So as far as buying the 55 low on 58, I would not. Chances are we're probably going to go lower. Bar 59, bull bar closing on its high. I think it's a trap. It's a double bottom. You can call it a wedge or an expanding triangle, but a lot of selling pressure. The past 5 bear bars have been bear bars, and only one closing above its midpoint right here. I'm talking about these bars, not this bar. 58, 59, bull bar, but probably sellers above. And then you can see everybody started giving up, and we quickly got a big bear bar on 60. Whenever I'm flat and I see a bar like 60, I immediately just hit sell the market because the odds are high you're going to get a second leg down. And in this case, we got followed through 61 consecutive bear bars, sell to close. Odds are you're going to get a second leg down and fall below 5. And then we got a big bear bar on 62. What about buying the close at 62, betting on exhaustion? No way. The odds are we are going to pull back. So I do think traders buying here will make money, but it's not worth it. Better look to sell or sell a pullback. And then bear bar 63, but risk getting big, probably buyers below it. And then we formed a wedge on a smaller time frame with 62, 63, 64, and a bull bar 65. What about buying 65? I would not. If you buy above 65, first off, you can buy above 69, but you can buy above 64, not 65. You can buy above 65, but if you do, realistically, I think you have to buy more below the 64 low. So if you're buying here, you got to buy more below the bar and use a wide stop. And most traders are not capable of doing that. And you can see we tested near the bottom third and reversed up, but that's 2 attempts up. We rallied, pulled back, rallied again, and that increases the risk that the next bar will be a bear bar. 66 bear bar, probably buyers below, bad low 1, but I suspect we'll get a second leg down in an attempt at these lows. 67, another bear bar, but probably disappointed bulls down here. Disappointed bears buying back their shorts down here. So I think realistically, there's more buyers down here than sellers, and we'll probably test the red line at the bottom of 5. Doji, 68, probably buyers below. And then 69, a second leg down from 66, 67. So you can see the market sold off and found buyers, and we couldn't even close below 68. So traders are obviously buying down here. And then we got a surprise, 70, probably going to get a small second leg up. And then we got the second leg up, 72, testing the 5 low and the moving average. What about buying up here? Well, it's 2 legs up, 66, pause, 69, second leg up 72. And the second leg 69 to 72 is nested with two smaller legs, rally 70, pause, second leg 72. So if anything, there's probably more sellers up here than buyers. So this is actually a bad area for bulls to be buying. If anything, you have bulls selling out of their longs and bears looking to go short, but late in the day. And you can see 72 got another push up, forming a wedge, 74. And then we tested down to the lows on 75, 76, 77. And then we pretty much went sideways into the close. For stop entries, I thought the first credible stop entry is, these are a little bit difficult, bar 1 and 4. If you're taking them, I think it's kind of tough. If you're buying there in the middle of the tight trading range, you're really better off using a wide stop. Otherwise, I think it's better to wait and buy above 14, maybe, or buy above 11, stop below 10, or stop below 7, stop below 5, taking a chance for forming an early bull trend. You can buy above 11, you can buy above any of these bars. But if you do, you need a wide stop. And then I think a lot of traders will get out below 22, even though the odds are we're going to go sideways. It is a wedge right here. And that increases the risk that it could be an endless pullback and lead to a downside breakout. Bears, if they sell, they probably get out above 24, certainly 28. Bulls, they can start buying again. And where do the bulls get out? I think they have to get out below 40, and others would get out when this starts to go sideways. Bears, they can sell below 40, but it's a Walmart trade. They sell below 40, stop above, and they hold short. Where do the bears get out? Some get out above 53. I don't think they have to. And then if they get out below 53, maybe they sell again below 56, or they sell below 58, 4 consecutive bear bars closing on their lows, or they sell during 60. Bears, they sell 60, they sell 61, 62. They probably get out above 64, or anywhere in here, certainly 71. And realistically, that's probably the last swing trade or always in trade of the day. For limit orders, you can buy below 2, you can buy below 7, scaling lower. You can also sell above the 2 high up here. So lots of limit order trades. You can buy below 9, scaling lower. I thought buying below 14 made sense, but a little bit tricky. I thought selling above the high of 17 was a logical trade. Buying below 25, that's probably a decent limit order. And then I thought selling somewhere up here above bars is a sensible thing. And then as far as over here, a little bit tricky. Probably buyers below 66, scaling in lower. That made sense. I thought buyers below 68 made sense. And sellers probably above 72 or 73, 74. That made sense, but late in the day. Buy the close, sell the close. I thought probably buy the close. It's pretty tough. I don't know if any of this is really buy the close. You can buy it, but realistically, it's buy the pullbacks. So you see a bar like 14 closing, and you know that it's a breakout pullback buy and a bad high one. Therefore, instead of buying above 14, you buy the pullback on 15 for a scalp. And then other than that, I thought the obvious buy the close, sell the close was sell the close 60, 61, 62, and even 63. But at that point, the risk is so big, the odds are 63 is going to get a pullback. So I don't think it's really a great sell the close bar. So why did we sell off sharply? It was a sell vacuum. Most breakouts are buy and sell vacuums, and buy and sell vacuums of testing, support, and resistance. So that's exactly why the market sold off. And what I mentioned earlier, these breakouts are deceiving. They're in the middle of a tight trading range. And because of that, on a 5-minute chart, you see these really strong trends. However, on the higher time frames, they're really not all that impressive. So we just go to a 240-minute chart. Where is the really strong trend? We had a strong trend here. Lots of bars above the moving average. Very big bar. This big bar is enough to make the market a trading range. It doesn't mean we're going to go straight down. What it means is you'll have some bears selling here and scaling in, But the bulls buying here, they know they're probably buying low in a trading range, but now this is buying high in a trading range. Therefore, they'll sell up here. And when the market starts to rally and do this, traders start selling above bars, betting we're going to pull back. We got a bear bar here, pulled back a little bit, market went lower here, and then we tried to form a bear channel. We broke above this high here, but we stayed under this lower high, this high right here. This is an example of a major trend reversal. You have a bull trend line break, higher high, has to go lower, and then it has to form a lower high here. And now the market's deciding, are we going to form a major trend reversal and reverse down? Or is this part of an overall trading range, which I think a trading range is more likely than a major reversal. So where do we go tomorrow? Well, tomorrow is Friday, so weekly support and resistance is important. We have 3 consecutive bull bars. I suspect that the midpoint of the week will be important. If the bulls are lucky, maybe the market will test back to the open of the day. Someone's asking if these are live every day. I try to make these videos when I can, but if you go to the YouTube channel and click on live, they're recorded. So every one of these on YouTube has been recorded and you can watch them at any time. But back to what I was saying, I think the weekly chart, I think we're probably going to try and close around where we are. And then the daily chart, middle of a tight trading range. So when I look at this, I think the market is fairly peaceful. It's neutral. There's neutrality right here. And because of that, I doubt we're going to go really far up or down. We still have the moving average below, and that's obviously going to be a magnet, and that increases the risk that we have to get down there. I don't know if we will tomorrow. Realistically, I suspect buyers below. But the more, right now, we have a really strong rally on the daily chart. And this is a strong enough rally. I like to think about it like this from the Globex perspective. It's lots of bull bars up. And the bears, they first have to make the market start going sideways. Once they make the market go sideways, at that point, the bears will have a chance at getting a reversal down. This is the making the market go sideways part. And we're not done yet. The bears, they need to do more. The odds still slightly favor the bulls getting a second leg up. Crude oil had great examples of consecutive buy climaxes and sharp reversals. It's like right here, consecutive buy climaxes. We had a really big bar. And this bar, this was on August the 12th. So let's go to August the 13th. This bar, when you look at it on a 5-minute chart, is really strong. Matter of fact, let's look at a 15-minute. So there's the 15-minute. And you can say, wow, what an incredible rally on this day on the 12th. And when you look at it from that standpoint, it is an incredible rally. But when you look to the left, this is a buy climax and it's probably exhaustion. It may take a day of the market going sideways before you get the reversal. But once it starts going sideways long enough, you can quickly vacuum back down. And then if we go to a 60-minute chart, we can see it. We had a spike, tight bull channel, bull break out of the channel. And now we're testing near the bottom. I say that because that's somewhat what happened today on the higher time frames. We had a tight bull channel and then a decent breakout, but this was probably more of a channel in the early start of a trading range, and that's what led to the reversal down. Okay, thanks everyone for tuning in, and I will talk to everybody soon. Reminder: tomorrow's end of day review is in the trading room, so if you're signed up for the trading room, you'll have access to it. Otherwise, the next YouTube end of day review will be on Monday. Hope everyone has a good rest of their day.